All right, let's just jump right in. What we're about to explore is, well, it's a bit of a thought experiment. Think of it like a piece of financial history, but it's written from the future. It's all based on some really fascinating research from a firm called Citrini. And we're going to look at a scenario that, honestly, hasn't gotten a ton of attention. So yeah, you're going to want to buckle up for this one, because we're about to jump forward in time.
Okay, picture this. It's 2028. You wake up, it's the morning of June 30th, and this is the number that just flashed across every screen. 10.2%. That's the unemployment rate. And yeah, it was a surprise, but definitely not the good kind.
So, of course, the market tanks. But here's the really weird part, the unsettling part. The traders? They've kind of grown numb to it all. I mean, just 6 months ago, a number like this, it would have triggered a circuit breaker, stopped all trading cold. Today, it's just another Tuesday. Just another day in a crisis that's been dragging on for 2 years. So the big question is, how on earth did we get here?
All right, let's do a postmortem. Let's piece together exactly how this all happened. We're going to rewind and reconstruct the chain of events that took the global economy from what everyone called contained and sector-specific to, well, something totally unrecognizable. And it happened in just 24 months.
So the really strange thing about the period between 2026 and 2028 was this tale of two economies. If you just looked at the headlines, everything seemed amazing. You had AI driving productivity through the roof, GDP was growing like crazy, corporate profits were hitting record highs. But if you peeled back that top layer, the real economy, the one where actual people live and work, it was withering on the vine. Real wages, collapsing. And consumer demand, it was just drying up.
And this is where a new term started getting thrown around. Ghost GDP. What is it? Well, it's all that economic output being cranked out by AI. It shows up in the official numbers, right? It makes the GDP figures look great. But here's the catch. That money never actually circulates through the hands of real people. You had like a single GPU cluster somewhere in North Dakota generating the same output as 10,000 workers in Manhattan. But that wealth, it wasn't being spent on cars or vacations or going out to dinner.
So where did this all start? What was the spark? To find it, we've got to go back to 2026. And we're looking at the very first domino to fall. The software industry. And what's wild is that this is a story of how a bunch of companies all made perfectly rational, smart decisions that added up to one giant catastrophic mess.
It really all kicked off with one simple question. See, by late 2025, these new AI coding tools, we're talking agentic AI, meaning AI that can basically write, debug, and ship complex software all on its own, they'd gotten so good, so powerful, that a single developer could basically rebuild a pretty decent software product in just a few weeks. So you can imagine what happened when those big six-figure renewal contracts for SaaS products hit the desks of CIOs. They all started looking at each other and asking, wait a minute, why are we paying for this?
And that question kicked off a really dangerous feedback loop. Let's take a company like ServiceNow, right? A huge player in workflow automation. When their growth started to slow down in late 2026, what did they do? They laid off 15% of their staff, and then they took all the money they saved and poured it right back into the exact same AI technology that was eating their lunch. It's this crazy irony. The big established companies that were most threatened by AI ended up becoming its biggest champions.
And this created the engine at the heart of the whole crisis. We can call it the intelligence displacement spiral. It's a nasty, negative feedback loop with no off switch. Think about it. AI gets better, so companies cut white-collar jobs. Those people now have less money, so consumer spending falls. That puts pressure on companies to cut even more costs. And how do they do that? By investing in, you guessed it, more AI. And this thing didn't stay contained in the software world for long. It started to spread fast.
By early 2027, this wave of disruption found a new target. Its next victim? Basically any business whose model was built on things being just a little bit difficult or inconvenient for humans. See, we entered this new era where personal AI agents became the norm for everybody, just humming away in the background of our lives, constantly optimizing everything.
And man, the casualties just piled up so fast. Think about it. Travel websites, gone. Your agent could book a whole trip, flights, hotels, everything, way faster and cheaper. Insurance companies, their whole business model of you forgetting to shop around was dead. Your agent reshopped your policy every single year. Financial advice, tax prep, real estate commissions, even those food delivery apps, all of them.
Trillions of dollars of value was built on the simple fact that you, a human, are busy, you're tired, and you probably won't bother to find a better deal. But an AI agent, it's never tired.
Yeah, there was a very specific type of business model that just got vaporized. You could call it habitual intermediation. The best example is a company like DoorDash. Their real advantage, their moat, wasn't some amazing tech. It was the fact that their app was on your phone's home screen and it was dinner time. That's it. But an AI agent doesn't have a home screen. It doesn't care about your habits. It checks 30 different delivery platforms at once and finds the absolute cheapest, fastest option, period. Every single time. All of that brand loyalty just went poof, overnight.
Okay, so once these AI agents were handling all the shopping, they started looking for the next thing to optimize, and they went after the biggest piece of friction in the whole system: payment fees. You know that 2 or 3% interchange fee that gets tacked on to every single credit card transaction? To an optimizing AI, that just looked like waste. So the agents started routing payments around the credit card networks, using things like crypto stablecoins, where a transaction settles instantly and costs like a fraction of a penny. And that was a direct hit to the very plumbing of consumer finance. Companies like MasterCard, Visa, Amex, they got rocked.
And this right here is the moment the problem jumped the fence. This is where a disease in the real economy metastasized into a full-blown Stage 4 financial crisis. What started out as a software problem or a payments problem was about to become everyone's problem. Just look at how fast things fell apart in 2027. It starts in April. Moody's downgrades a massive $18 billion chunk of software debt that's being held in these private credit funds. Then by September, a big name, Zendesk, defaults on its $5 billion loan. By November, the regulators finally wake up. They get spooked by how much of this junk debt is sitting on the books of insurance companies, so they tighten the capital rules. And boom, the whole market just crashes.
Now you might be wondering, why did this get so toxic so fast? Well, it was because of a hidden vulnerability. This whole world of private credit, basically loans made by big investment funds instead of regular banks. Everyone thought it was super safe because it was funded by what they called permanent capital. But here's the dirty secret. That permanent capital wasn't some abstract pool of money. A huge chunk of it was actually the annuity savings of regular American households. Your parents, your neighbors, their retirement savings had been funneled through insurance companies and plowed into these tech loans that were now blowing up. Main Street was on the hook, and they didn't even know it.
From there, the crisis started to threaten the absolute bedrock of the entire financial system. You had waves of high-earning, white-collar workers, programmers, managers, consultants, losing their jobs. And suddenly, in the quiet corners of the credit markets, people started whispering a question that just months before it would have been absolutely unthinkable. Are prime mortgages, the safest loans on the planet, are they still actually safe?
And this wasn't just some theory. By June of 2028, you could see the impact in the real world. Home prices in places like San Francisco, Seattle, Austin, all these tech hubs were plummeting. And listen, these weren't subprime borrowers from 2008. These were people with near-perfect credit scores, the absolute safest bets in the mortgage world. It's just that the entire world had fundamentally changed after they signed on the dotted line. And that brings us back to where we started, our present day of June 2028. The system is in a downward spiral, and the big problem is that the policy response has been totally useless. Because everyone's trying to treat this like a normal recession, a cyclical downturn. But it's not. This is a permanent structural shift driven by technology. And this created this impossible paradox for the government, a real catch-22. Think about it. The government makes most of its money by taxing human labor, income taxes, payroll taxes, but as that human labor gets replaced by AI, that tax base just erodes. So at the very moment the government needs to spend a ton more money on things like unemployment benefits and stimulus checks, its income is falling off a cliff.
Okay, so this has all been incredibly grim, I know. It really begs the question, is this future we've just laid out, is it inevitable?
The answer is no. Because you're not actually watching this in the year 2028. You're watching it right now, today. This whole thing, it's been a thought experiment. It's a history of a future that hasn't happened yet. Right now, the S&P 500 is near its all-time high. Those dangerous negative feedback loops we just talked about, the ones in the job market and the credit markets, they haven't really started spinning yet. And that's the whole point of walking through this. The goal isn't to be a doomsayer, it's to be prepared, to see what could be coming down the pike. Because right now, we still have time to be proactive.
And that brings me to the really powerful closing line from the Citrini research that inspired all of this. They write that the economy, it can find a new balance. The machine intelligence revolution is absolutely here. And yes, the premium on human intelligence is going to get smaller. But the canary in the coal mine is still alive. So I guess the question for all of us is, what are we going to do before it stops singing?